Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me at Fair Square Finance, if you want to join our community, finding-value.com, I dive deeper into all these topics and subjects, looking for potential investment opportunities, sharing those opportunities with everyone in the community. We do have a special going on. Special is the coupon code for a 50% off discount for the first month only on a monthly membership, and a larger discount on the yearly membership for anyone wanting to switch from a monthly to a yearly or signing directly to a yearly membership. JC Parrott says, who thinks this move in stocks over the past week is just a bear market rally? I think that's what everyone is trying to figure out. that's the question. And I don't know if anyone really knows. There's a lot of uncertainty in the market. We don't know exactly what's going to impact the market from tariffs fully. So I think that's the big question mark. And if you were to look at the S&P 500, what I generally see in a bear market rally is large selling pressure candlesticks, those big reds, and then you'll see a weak bounce up here. We are underneath this resistance level. So it very well could be a bear market rally where we come on up and then roll over and sell off again. That is very much in the cards for the realm of possibility. But there's other things in the background that could also impact all of this. And some of the things, if you listen to Donald Trump, he talks about certain eras that were great for America. During those eras, ERA, the era, not earned run average, but the era that I'm talking about is high tariffs, or they had taxes on tariffs, but they had no federal income tax during those timeframes. I think he is trying to replicate something on the lines of that condition. So we don't know what the full impact of the tariffs will be in terms of the percentages and how that impact will hit the markets, but I also think he's working in the background on reducing federal income tax. And I think everyone's looking at the tariffs, but yet is forgetting potentially about the federal income tax. Now, who is that going to benefit if he drastically reduces the federal income tax? It will not benefit those that make a little money. It will benefit those that make a lot of money, because what that will do is that it will tax everyone who consumes, which is everyone, and then the larger earners, the ones who actually pay into federal income tax, the bottom 51% pay zero federal income tax. It's like 50 or 51%. And then obviously the bottom like 60 to 75%. So if you were to go to 50 to 51% to 75%, let's say, they pay very little federal income tax. And then the ones that are in the top 10%, well, they pay everything basically. And I think that tax structure is more fair, where everyone has to pay a tax. I would agree with that. And the people who would benefit would be the ones that are contributing to society, that would basically stop paying federal income tax. I hope that goes through. If we do keep these tariffs, I would like to see federal income tax go away. That would be very, very good for a lot of people who contribute to society and do jobs that maybe others aren't able to do. So I'm all for merit-based stuff, and I want to get rid of unethical dealing. So anything where if I could, I would really reduce government massively. And then whoever makes stuff in this world would get to keep whatever the heck they earn. It's keeping private property to some degree. So there's a lot of stuff going on in the background here that it's not so straightforward. Everyone thinks, I think, that we're going into recession. It's going to be this gigantic bear market, and that is the path that we are 100% going on. I'm in the camp that's open to either direction. I think that we're in the middle of a demographic in home buying years with increased spending that looks pretty good from a demographic perspective. But that doesn't mean we can't get a recession. If we have a one-time large tariff increase, then yeah, that's definitely going to have an impact and very well could slow down the economy because of increased taxes, which is a drag on the economy. So I don't know. I don't have a outlook here. It's too complex and there's too many unknowns for me to have an opinion on one side or the other. And I think it's too complex for the majority of people to even have an opinion. It's very hard to see what is coming. Spencer says, by the way, even if you could replace income tax with tariff revenue, which you mathematically cannot, but let's just pretend you could, what's the point? You just replace income tax with a consumption tax. How does that leave you any better off? Well, for those that pay a larger income tax, then we need to block government from being able to create fiat currency. That is the root of all of the problem. And then if you can block them there, they can't grow their stupid government. And that's where that's where you got to block them. You got to block them there. There's like three main things in the original Constitution that blocked government from doing unethical crap. One of it is a gold and silver backed currency. That's number one. Number two is being able to limit who could vote. And I don't necessarily agree with maybe the original, setup of who could vote, but you have to constrain who the heck can vote. You can't have illegals voting. You can't have all this stuff. That doesn't make any sense to me. Like, how can you take people outside of the system and have the ability to vote? That doesn't make any sense. So all of this stuff, the tax, less taxes is better. But we need to figure out how to block government from just creating infinite amounts of money, which is another tax through the currency labeled as inflation. Chart of the day here. It says the cheating game inside OPEC Plus. 3 countries account for the bulk of the cheating. Iraq, Kazakhstan, and UAE are overproducing on combined basis. 1.2 million barrels per day above their official output target. Unsurprising that the Saudis aren't happy. Well, here's my question then. If these guys are cheating by 1.2 million barrels per day, Iraq, Kazakhstan, UAE, the bulk of it, with a little bit of cheating over here in Algeria and Azerbaijan is behind it, but when they say they're going to increase production, are those actual physical barrels hitting the market? Or is it just accounting for what they're already cheating? Now, if they're cheating this bad and we are still running deficits and eating through inventory, then the market probably has it wrong. How do they have it wrong? Well, that means that inventories are still declining with much larger production. And on top of it, our supply, our capacity, so the spare capacity of supply is much lower than what we think. So who knows what the actual number is if all these people are cheating? Who knows how much is actually going to come to market that is additional barrels? What if everyone has this wrong? What if they're not accounting for the cheating here and they think it's going to be actual additional barrels? I think everyone's cheating. I think spare capacity is much tighter than what most people think. And I think the price is far lower than where it should be. That's my opinion on this mix. But these are the people who are cheating, and that's how much. 1.2 million barrels per day. OPEC plus actual oil production increase could reach 20,000 barrels per day in April, IEA. So Interfax says OPEC plus countries' oil production growth in April may amount to just 20,000 barrels per day, rising to 225,000 barrels per day in May, International Energy Agency analysts said in the latest monthly report. Although the alliance's total quota in April should increase by 138,000 barrels per day, this plan is offset by commitments from volunteers who overproduced in previous months and must now compensate with cumulative cuts of 249,000 barrels per day, the IEA said. Given March's overproduction exceeding 1 million barrels per day, only Saudi Arabia and Algeria will be able to increase production in April by a total of 20,000 barrels per day, it said. So there's all these number games going on in the background. I want to see what inventories do this summer. If we start bringing on a whole bunch of barrels, let's see if we continue to have inventory draws. If we continue to draw on inventory, that's bullish. It's bullish even if the barrels are coming back on. Silver Chart says, still bullish uranium. I view the uranium sector as presenting the most favorable risk-reward setup across the commodity space. The trend is clearly down, and a bit more weakness may lie ahead, but that downside risk is thought to be minimal relative to the significant upside potential. Extreme oversold technicals paired with a bullish fundamental backdrop is the 1-2 combo that contrarians patiently wait for. I think there's a bunch of stuff that looks good. Coal's been pulling back quite a bit. Oil's been pulling back. Energy service, now, I don't know if they've 100% bottomed yet, but I don't think they look bad. They've pulled off, a lot of the companies have pulled off their highs quite a bit. We're not talking 20, 30%. We're talking, 60, 70%, which is your Fibonacci retracement, 0.618. They're all around that general area. A lot of them are putting in double bottoms as well. So, yeah, I think uranium looks good. And I also think there's other sectors that look good. And you have to buy it when things are down. You don't want to buy it when things are way up. Gold's up a lot, guys. Gold is up. That's not what I would buy. I would go buy uranium. I'd go buy gold, oil. I'd rather go buy stuff that's down. And then you just wait patiently for the market conditions to switch and come around into favor. I just do opposite of everyone else. When everybody thinks something's crappy, that's generally where I buy. When everybody tells me I'm wrong, that's generally the great spot to be. Because most people are generally wrong. Here's Cube. He says, I remain convinced when oil does rise, it'll be an inverse move of 2014. Some event will kick reality in the jaw. In 2014, fundamentals deteriorated as price lethargically stayed high, ignoring reality. Then, within months, prices fell to $30 a barrel. We will eventually do the opposite of 2014. So we're going to stay low, low, low. It'll lethargically move up a little bit maybe, and then it will ramp higher when people figure out that there's a problem with oil. I don't know the exact timing of it. Maybe it's another, 6 months or a year out, which I hope. Why do I hope that? Because then I can accumulate a whole bunch more in my favorite companies. I can accumulate a whole bunch more. I will be so set for this bull market. It will be fantastic. Here's silver, SLV. How is it doing? Breakout here in the cup and handle. It looks good. And then there's your projections from this is wave 1, wave 2 pullback, and then you've got a wave 3 that we are in. And there's many different price projections there, and I'm sure you guys here. I'll read them off: 43, 138, 300, and $666. 666. Watch out. Spencer says Goldman Sachs also expecting zero economic growth for 2025. Zero. We were printing +3 real GDP at the end of 2024. So we expect U.S. growth of only 0.5% in 2025 is their opinion. Now, I don't use this as a guide. I just use this as information to see what other people are thinking. In 1990, when we had that recession, did you know that oil demand growth went up? It went up. It went down in 2008, which was one of the worst the great financial crisis. But most other areas in 2000, 2001, during that recession, oil demand went up. So demand is really hard to knock lower unless you have a pretty large contraction of GDP. Just keep that in mind. JSG says, agreed. Right now, the bear case is so much narrative. Demand going to fall, supply coming online, etc. Meanwhile, the recent hard data, which is looking backwards, is bullish. USA crude production missed January 25 global inventory decline, and USA commercial stock first quarter 2025 is a draw. We're drawing down on inventory. So all of the hard data is bullish, and all of the narrative of what's coming in the future is bearish. So it's bullish, hard data, bearish, what's coming out in the future of what people think. So that their thoughts could be wrong. They could have this wrong. Johnny Oilwell says, once upon a time, oil went up in price by 4x. Drilling rig count went from 1,000 to 4,000 rigs, and production stayed flat. It can happen again. Reservoir mechanics always win. They're talking about the geology. So this was back in the 1970s. We hit peak oil in 1970. This is 9,000, or it should be 9.3 million barrels, perhaps. I think that's maybe what it is. And then you can see the rig count go up, and then look at the production. It actually went down. It didn't really move upward very much. So we added all these rigs. We tried to hold it steady. It remained flat for a little bit. And the increase of drilling did not result in an increase in oil production. That is what I think is coming. We are going to increase the rig count dramatically, and I don't think we're going to see worldwide oil production go up as much as what people think. It may go up. I'm not saying it won't, but I don't think it will go up as much as what people think. They think that money drives this thing. It doesn't. Physics and geology, the reservoir mechanics, is what drives it. And if you start to lose production on some of your shale, I think it's going to be real tough to replace it because they have pretty strong decline rates. More signs of a potential market bottom, and I think he's talking about the overall current percentile here and how low we are for equity positioning. So this is equity positioning, which is low in 2011, 12, another one in 16-ish, 2020, and 2022. We've got another low one for systematic equity positioning. We've got another one, volume control funds, estimated equity allocation, very low. And this is your risk appetite indicator. Risk appetite's really low, which also lines up with previous market bottoms. So that maybe could be a potential bottom, maybe. Eric Ewan says, holy cow, 6 trillion USD worth of US treasuries mature in just over a month. 6 trillion. Americans, you must pay off 9 trillion of your debt this year, 6 trillion of which will come due in just over a month. Your best choice is to remove all tariffs and borrow money from other countries. Yes, that is a good option. Freight futures, AM update, dry bulk was down 3% for Capesize, Panamax was flat, and then tankers were flat for VLCC and Suezmax. When you win so hard, no one wants to own your stocks anymore. This is the record number of FMS global investors intending to cut U.S. equities. A lot of them cutting U.S. equities. Rock Bottom Entry says the TSX Venture signals a generational rally in natural resource stocks has begun. So 10-year inverse head and shoulder pattern, shoulder, head, shoulder, and then we'll start working our way on up on the right-hand side of that shoulder. We've got bullish momentum that's being generated, which is always a good thing, and a little bit of volume is increasing slowly. So hopefully that's what we see. This is also highly tied with currency exchange rates. look for the Canadian dollar versus the United States dollar. And I think that they will move in sync, where the Canadian dollar outperforms the US, and this will work its way on up and suck in money flows from that currency differential. Another one from Calum. He says, "Oh, about 50% expect recession." Look at the expectations here. My God. Hard landing 50%, soft landing 37%. No landing is literally 3%. It's no one. And that changed. Look at how dramatically that changed. That went from January of 25, that was 38% no landing, 50% soft landing, and 5% hard landing. That's the sentiment change that has occurred over the past 2 months. Everyone's in the hard landing camp now. Scott Bessent says, if we measure uncertainty by the VIX, I don't want to make market calls, but it seems that the VIX has spiked and likely peaked. Bull freaking ish. I'm reading this as Bessent is saying, we'll get tariff deals. We need some time. More progress is coming. So that's what his opinions are. I'm surprised that these guys talk about markets like this, because obviously their opinions they do hold some weight. So he thinks the VIX has peaked, which means we probably hit a bottom, is what he is saying. Jesse Colombo says, people keep asking me when to sell gold. Egon von Greyer said it best. You should only sell gold when governments start running surpluses, stop printing money, and reduce debt, all of which is highly unlikely. And then he says gold should be held long-term, potentially for decades. That's his opinion. I agree with that. Totally agree. I would have been really well off just buying a bunch of gold in 2000, early 2000s, right when I started working. And even if you accumulated gold the entire time, still would have been better off doing that than the S&P 500, unless you bought the bottom of the S&P 500 in 09, 2010, 2011. But gold's done really well for the long term, and it looks like it's going to continue to do well. BFA, FMS, the current level of sentiment is the 5th lowest on record, behind 2001, 9, 19, and 2022, which were all good times to be purchasing equities. All of those times. Porter Stansberry says, repeat after me, they will never cut spending. Not ever. A doom loop awaits and a default. Says it's funny because to me the trade is just so simple and clear-eyed. Neither party can stop spending money. Neither party wants to raise taxes. They won't. They're just going to continue to spend, guys. They have to in order to keep the system liquid. They got to keep spending, and they got to bring that money into the system to keep the system alive. That's part of the system. Grady says, posted this ratio chart at the green dot, saying it's a true lifetime opportunity not to be missed. This month, the chart had a higher high above the breakout high. The chart has now confirmed that the blue breakout is for real. The higher high means that the larger trend has now reversed. And this means that it's now confirmed that silver will outperform the S&P 500 going forward. The global capital rotation into precious metals is not starting now though, nor is it confirmed that. It started when all the precious metal ratio charts I have posted turned big picture, which I've posted in real time for each chart. So the confirmed capital rotation turn is not now. It happened many, many months ago. Very few believed this chart below when I posted it at the green dot. But that is how it must be. Most have to be at the wrong end of sentiment at big levels, breakouts, and turns, including all analysts, experts, and services. Think about what that really means for how you spend your time searching for information, how you follow, what you read and watch, and how you play the market. So what this is silver versus the S&P 500 on the monthly candlesticks. It's broken out, guys. Bought big the silver junior miners. So did we. We bought a whole bunch of silver and gold miners back in 23, 24 at this bottom here. It's broken out. Silver is going to outperform the S&P 500. Gold's already outperforming the S&P 500. It's all coming, guys. It's all going to unwind. You're going to make a whole bunch of money if you can buy it low and just sit in it. If you can just sit. And that's where a lot of people struggle. They can't sit and wait. Here is you think the gold bull market has already ended. It hasn't even started yet. This is your implied allocations to gold. Looking back at 2011, we peaked at 8%, and we're at like 2% right now. Super low, and this is implied allocation to gold miners. That peaked at maybe a little under 1.5%, and we're underneath. We're probably at 0.25% or so. Very, very low. We can go way higher in all this. The Ape of Gold Street says, some charts I like. It isn't rocket science to see where you should put your money right now. And here is the silver miners to S&P 500 ratio breaking out. We just went over that with Grady. We've got commodity to equity ratio versus the US dollar. The dollar's peaking and ready to roll over, just like every other commodity boom. And we're going to run into a big commodity boom. We're incredibly cheap for the commodity to equity ratio. We've got the S&P 500 to gold ratio breaking down in favor of gold, and that always has happened during commodity bull markets. This is all the information that just overlaps. And here's the NASDAQ 100 index versus money supply. It's peaking like it did in 2000. Total and utter bubble. So I wouldn't want to be here for the overvaluation. I want to be in stuff that's undervalued, aka commodities. And then you just sit in it and wait. That's all you do. You find good companies, you sit and you wait. Here's another one from RevCap. He says, BESSENT adamant in this interview that tax reform will be much more than just a TCJA extension. Expect more. He also ended the interview with the VIX spike has likely peaked and to expect more clarity on tariffs and tax in the coming weeks. I think that they're going to release some bombshells in taxes. That's what I think. And I think the market's going to be hopefully pleasantly surprised. But that's my intuition. Doesn't mean I'm right. But these guys it's like they're talking like they know something that's coming. They're like, hey, Trump tweeted, it's a good time to buy. He did that in 2018 at the bottom. He did something very similar, a few days, last week or so. Now they're talking about the VIX spike has likely peaked, which is interesting. And then they talk about tax reform, which will be much more. So I don't think the market's looking at maybe what these guys might bring from a tax reform perspective. Everyone's looking at the worst case scenario from tariffs, and you could see the sentiment from above, how many expect a hard landing. I think these guys got some up their sleeve. Hopefully. This is SIL. This thing looks ready to basically break at any second for SIL, which is an ETF for silver miners. Looks really, really good. This one here is the Michigan Consumer Sentiment Index and recession odds. A 10-point drop in 1 month is typically a recession indicator, but it dropped hard last month as well. So the 2-month decline is 15 and 3-month is 20. The Michigan Consumer Sentiment Index measures U.S. consumer confidence, reflecting views on personal finance, business conditions, and buying plans. With consumer spending driving roughly 70% of GDP, sharp MSCI declines, like the recent 2-month 15-point drop from 65 to 50, can signal economic trouble. But what are the odds of a recession following this plunge? And then obviously they went through this. I'm not going to read through all of this information. It's quite a bit. But here's the chart, the U.S. consumer confidence. You can see it's declining over time. And that can lead to a potential recession. So BESSENT and Trump need to get moving on getting clarity around tariffs, and if they've got something up their sleeve for tax reform, they better start to bring it to the table here pretty soon. And that's where we're going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use that special coupon code. And we'll catch you guys later. This is Finding Value.